You don't have to understand the inner workings of a car engine to drive to the grocery store. I think a lot of us just kind of going into this conversation, you might be like, oh, they're talking about taxes. I don't know. Like, that's just way too complex. I don't want to read the IRS or the revenue code and all those things. But just know that really that taxes are something not to fear, they're to plan around. And we'll try to make it as digestible as possible today so that, again, you can have that clarity and confidence to drive to the grocery store as a tax planner, not necessarily know how every part of the engine works along the way. For a late starter, year-end tax planning is deduct, deduct, deduct. I think Sean even put 3 exclamation points on that in the book for the late starters chapter, because when you think about a late starter, they really shouldn't be worried about being crushed with taxes in retirement. I mean, we don't think anybody should be worried about being crushed, but especially not the late starter, because their biggest emphasis is on sufficiency. Their priority is saving and investing. And how can you save and invest more as a late starter is by, if it's possible, maxing out those pre-tax retirement plan contributions through work.
What tends to be true is most retirees are going to be lightly taxed in retirement. I know that's a contrarian message, but what tends to happen is the Internal Revenue Code, our tax laws, tend to like retirees. Now, is that 100% universally true? Of course not, right? But what tends to happen is the retirees that our tax code does not like tend to be very financially successful later in their retirement. And those retirees are in the best position to bear tax risk.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hey, Jackie. Welcome back to Catching Up to FI. Welcome back to the U.S. I just got back from South Africa, and you just got back from Bali, and the show is still going on.
That's right, Bill. And I can see all the extra energy you got from being on your long distance trip, me as well. But we are not skipping a beat, and we got 2 heavy hitters today. We're going to be talking about taxes, the sexy part of taxes.
Well, yeah, we're going to make taxes sexy and real English, and get rid of people's fears over these taxes into retirement or early retirement. This book, I think, is revolutionary, and I would encourage all of our audience not only to read it, but share it with 2 people, because this is a hole in the FI community that is now filled with Cody and Sean's work. So let's introduce them. They've been on the show before, but it's been a while. So let's roll through this. So today we welcome back our dear friends and 2 of the most thoughtful voices in the financial independence space, Sean Mullaney and Cody Garrett. You probably know Sean as the FI tax guy. He's a CPA and financial planner who's built a huge following by helping people understand how smart tax planning can actually accelerate the journey to financial independence. Sean writes the Plutus Award-winning blog, FITaxGuy.com, on the intersection of tax and financial independence. He also has a personal finance YouTube channel. Sean last joined us all the way back on episode 13, Life and Taxes. Welcome back to Catching Up to FI, Sean.
Bill, Jackie, thanks so much for having me today.
We are glad to have you, but then there's also Cody, so you get double the fun. So Cody Garrett is a certified financial planner, and he is founder of Measure Twice Financial. And his work is all about aligning your money with your life and creating plans that feel intentional and not just optimized. So Cody appeared on episode 35, Music Money Man. So check that one out. And then we are long overdue to have them back. Like, they are now a dynamic duo.
Together, Sean and Cody have recently teamed up to write a fabulous brand new book called Tax Planning to and Through Early Retirement. Now, early retirement's in the title, but I would say it's for retirees at any time of life. It's a practical, approachable guide that helps people navigate one of the trickiest parts of financial independence. Who likes reading the tax code? You want to manage your taxes during the transition. Well, actually, Cody and Sean like reading the tax code, and they interpret it for us. And so how do you manage your taxes during the transition from earning a paycheck to living off your investments? We don't talk enough about drawdown, and today we're going to talk about that. The book dives deep into many, many pertinent topics like Roth conversions. Oh my God, I got some FOMO there. Withdrawal strategies, which we don't talk enough about, and how to make the most of your early retirement years, all in plain English.
That is right. And in today's conversation, Bill, we'll talk about why this kind of planning matters, their top year-end tax tips, their drawdown principles, moving through the 5 phases of retirement, and how a little tax awareness can go a long way toward lasting financial independence. So let's dive in. I am so ready to chat with you guys. Cody and Sean, welcome to the show.
Thank you so much. Yeah, it's so much fun thinking about your tax planning as something that's digestible. One thing that Sean mentions in the book, by the way, is that you don't have to understand the inner workings of a car engine to drive to the grocery store. I think a lot of us just kind of going into this conversation, you might be like, oh, they're talking about taxes. I don't know. Like, that's just way too complex. I don't want to read the IRS or the revenue code and all those things. But just know that really that taxes are something not to fear. They're to plan around. And we'll try to make it as digestible as possible today so that, again, you can have that clarity and confidence to drive to the grocery store as a tax planner, not necessarily know how every part of the engine works along the way.
Well, there's the automatic transmission and the manual transmission, and I'm still one of those guys that's 60 that learned on a manual transmission. I challenge any of the new generations to get into one of those cars and make it to the grocery store.
You guys have been all over the place. I was so glad to meet both of you in person at the Bogleheads Conference in San Antonio. You did a breakout session. I did a breakout session. You signed some books, and to me, this was one of the highlights of my trip, tax planning through early retirement. You guys were representing. How did you guys enjoy the conference? Was it your first time going, both of you?
For me, it was my 3rd time going. So I went 2023, 2024. It's funny, our world is so virtual now, and that's great because it enables a lot of self-employment. It enables opportunities and connecting in a certain way. But I will say there is still value in meeting person to person on occasion. And so some of these conferences are great for that. And then you also get to hear what's on people's minds and what's the latest and greatest. What are other people thinking about in a little bit of a different way than you do from behind the computer screen. And I think the Bogleheads, in terms of the quality of the technical content, there are few conferences that rival it. So I really enjoy that. And I just enjoy getting to see Cody and Jackie and others and just mixing and mingling and seeing what's on people's minds.
I have total FOMO that I wasn't there this year. I've been the last 2 years. You get to meet your heroes. I mean, you get to meet generationally the people that have been influencers, educational folks in this space for a long time. And things are changing. The FIRE movement is migrating into Bogleheads and taking over. Christine Benz is doing a great job of generationally tilling the soil and bringing in new concepts, new ideas, because the Bogleheads originated in the 90s, and there's new technology, new ideas, new ways of doing things. There's new ways of looking at taxes, right, Cody?
Yeah, that's right. It's funny thinking about, I didn't know what an IRA was until I was 30. And by the way, I was 30 in 2018, right? So talk about not even knowing boggleheads, what are those things, right? I was thinking maybe that might have been a bobblehead to me back then. But yeah, it's really cool. But it's funny, even going into this conversation today, we talked about this idea that retirees moving forward will have less pension income than retirees 10 years ago. And I think that a lot of the content around there, even like going to the Bogleheads conference, it's really interesting to see the shift of going into retirement with a pension and Social Security, and then maybe a little bit of a portfolio to supplement. Whereas now we're shifting into this world of really it's up to you, right? Maybe you'll have some Social Security, but it's really up to people to really be in control of their own accumulation and saving and investing. I actually think it's nice to have more control and command over our retirement planning moving forward, but it requires having things like the Bogleheads conference to really have these fresh new ideas come out so that we're not just listening to the same things we heard 20, 30 years ago.
Absolutely, because the center of the bell curve of our audience is Gen X. We call them the lost generation, the silent generation. People forgot about us. It was the transition from defined benefit to defined contribution. You didn't know what an IRA was when you were 30. I didn't know until I was 50. So take that, Cody. I didn't know what I was doing. I was stumbling around in the dark until I took back my money from salesmen and banks and took ownership of it myself. which is entirely possible. And it's entirely possible to take ownership of your taxes. And that's what we're going to talk about today. Let's start with your top tax tips, because it's the end of the year. The final quarter of the year is a big time to tax plan for the next year. Sean, why don't you take it away with some of the tips you have for our late starters or in general?
So one of the big ones this year is the donor advised fund. Now, you have to be charitably inclined, but we had this one big beautiful bill back in July, and one of the underreported aspects is this sort of mini revolution in charitable giving. So what they're doing is, starting next year, they're changing some of the rules. Two big ones: there's a small non-itemizers deduction for cash charitable contributions up to $1,000 a person starting next year. And the one I want to touch on from a planning perspective is a haircut. So what they're saying is, you have to take a look at your adjusted gross income and figure out a number that is 0.5% of that. So if you made, say, $200,000 of adjusted gross income, quick math on a podcast, always dangerous, but I believe that's $1,000. So if you're going to deduct your charitable contributions starting next year, in that example, you would just slash $1,000 from the otherwise allowed deduction. So what that means is 2025 might be a really good year if you're charitably inclined to contribute, particularly appreciated securities, and we have an up stock market, appreciated securities to a donor advised fund, take the full deduction this year, okay? And then you can move forward. You could use that in 26, 27, 28 to make your charitable contributions, but you've accelerated a deduction into a year. You can get 100 cents on the dollar of that deduction. So if you're charitably inclined, donor advised fund this year might make a lot more sense than it might make, say, next year.
Yeah, I'm a big fan of donor advised funds. I hold mine at Fidelity, which does a great job. Vanguard has them. There's other institutions like Daffy, not to diss any other folks, but we lumped 3 years of contributions of appreciated stock into a donor advised fund. Nobody pays tax on it. And I use it as a giving plan for our family, where throughout the year we accumulate smaller donations. My family votes on what is most impactful to us, and we make bigger donations on Giving Tuesday, and they'll inherit that. And so you can create a giving engine with a donor advised fund that outlives you and grows with your family. It is a great tool to give, which some view as the first part of a financial plan. So I completely agree. Cody, what about you? You got a tip for us?
Yeah, so I'll add on to that. Another thing in 2025 is not everybody will be able to itemize their charitable contributions this year, but using the donor advised fund, like stacking those multiple years of contributions into one tax year, is also going to be beneficial because of the new $40,000 state and local tax cap. That was at $10,000, now it's at $40,000. There are some income phase outs, but those phase outs are actually pretty high, so it'll be less concerning to our audience. The biggest thing, really mirroring Sean there, is that for a late starter, year-end tax planning is deduct, deduct, deduct. I think Sean even put 3 exclamation points on that in the book for the late starters chapter, because when you think about a late starter, they really shouldn't be worried about being crushed with taxes in retirement. I mean, we don't think anybody should be worried about being crushed, but especially not the late starter, because their biggest emphasis is on sufficiency. Their priority is saving and investing. And how can you save and invest more as a late starter is by, if it's possible, maxing out those pre-tax retirement plan contributions through work. If you don't have access to those retirement plan contributions at work, but you still have earned income, maybe you're self-employed, et cetera, certainly there are some self-employed options, but also you might even consider, if you're able to, deducting traditional IRA contributions depending on your income. So the more that you can deduct this year, the more actually opportunity you have to save and invest with those tax savings. There's a common misconception. People say, if I'm limited to how much I can contribute to a 401k, whether it's traditional or Roth, if I contribute to the Roth, that'll end up being like a bigger contribution because those future distributions will be tax-free. But you have to keep in mind, like, for example, contributing, let's say $20,000 to a traditional 401k versus $20,000 to a Roth 401k, the Roth actually involves requiring more income to start. So whenever you contribute to a traditional 401k, just keep in mind that, like, it's really up to you to save and invest the tax savings. So take advantage of those deductions, but also utilize those deductions by increasing your contributions. Also, on top of 401ks, 403bs, 457bs through your workplace, don't forget those catch-up contributions, right? So you have the normal catch-up contribution of $7,500 for being over 50 or older by the end of the year. But also they have these kind of fun super catch-up contributions for those, 60 to 63.
Yes, yes.
Right. So on top of the $7,500 that I mentioned for like standard catch-up, also another additional $3,750 on top of that for those unique ages. But all in, you can see that late starters might be able to be contributing $31,000 or $34,750 to those traditional retirement accounts, which also gives them, by deducting those contributions. And by the way, on top of that, the HSA, Jackie's favorite, those health savings accounts. Yeah. I would just say that the priority here is deducting as much as possible in your late starter years so that you can save and invest and get to retirement even faster. And yes, like you will have to pay taxes along the way, or maybe not, right? Maybe we'll get into ways you cannot pay taxes in retirement, but really focus on contributing, saving, and investing even more through deductions.
Yeah, I completely agree. And I'm turning 60. I'm in that sweet spot. My wife's in that sweet spot. We're both individual contractors and have solo 401ks, which allows us to catch up. This is more for high income earners, but I can put away over $80,000 pre-tax into my solo 401k with this catch up and super catch up. And honestly, I don't want to give that up for the next 3 years, nor does my wife. So there's fantastic opportunities for everybody, but high income earners that are independent contractors or 1099 contractors should really pay attention to this. And Sean wrote the book on solo 401ks. So Sean, give us your next tip for the end of the year planning for late starters or in general that's important, a blind spot we might miss.
Well, so what I'm going to mention is just IRA contributions. So we were talking about workplace retirement contributions, and they're great. One of the good things about this one is you can wait till next year. And in fact, you might want to wait till next year. So what I'm talking about here is a Roth IRA or a traditional IRA contribution. And it's $7,000 this year. It's $8,000 if you're 50 or older by year end. And the nice thing with this is the contribution deadline is April 15th of 2026 for 2025. Now, if you do the contribution in 2026, you just got to make sure on that internet portal for your brokerage, just make sure you do the drop down and say, this is for 2025. The default is it's for the year you made it, right? So just make sure it's very clear, okay, this is a 2025 contribution, even though it's January, February, or March. Why might you want to do it that way? Well, if you're listening to this in December and you're like, I don't know what my income is ultimately going to land at for the year, it could be helpful to, all right, just wait. You don't have to rush this one. Wait until February, March, do a draft of your tax return, self-prepared or with a paid preparer, and you say, okay, where's my income coming out? And that can inform, hey, do I qualify for a Roth annual contribution? What does this all look like? And so that's one just to keep in mind. It's a little bit of a hurry up and wait. Now, not too long, April 15th, the deadline there, but that could be an effective one. And for a lot in the audience, even though Cody and I, and we'll talk about the book, we generally advocate for these traditional 401k, 403b type contributions at work, at home, we often advocate for Roth contributions to an IRA. And the big reason there is the ability to deduct that IRA contribution when you do it to the traditional, much, much, much more limited. Now, there are going to be some people who can deduct it, and it's worth considering. But a lot of the audience maybe is in their higher income years, in their, say, 50s. You said Gen X, right? So maybe you've gotten to a salary where, okay, you're doing great. I mean, you're still catching up, but the income number this year is pretty good, and you've kicked above the income level to deduct an IRA contribution. So there, a Roth might make a lot more sense.
Don't forget about the backdoor Roth, right? For those higher income earners where you don't meet the income limits. There is a way to do that.
Yes. The backdoor Roth is a two-step transaction. I've written about it extensively on my blog, and we're recording this in October. I could tell you in December, I've got 2 more backdoor Roth blog posts coming out in anticipation for the 2026 backdoor Roth IRA season. But the one thing I'm going to mention there is people ask, well, what's the deadline for a backdoor Roth? And the answer is there's no official deadline for the backdoor Roth. But remember, the backdoor Roth is a 2-step transaction. It's a non-deductible traditional IRA contribution followed by a relatively close in time conversion of that amount and any growth to a Roth IRA. And the step that has a deadline is that first step, the non-deductible traditional IRA contribution. That has to happen by April 15, 2026 for 2025. And that coding thing I mentioned, just make sure to code that contribution as being for 2025. And then the last thing is the backdoor Roth is not for everyone. The main thing you got to look at is the other accounts you have. If you have other traditional IRAs, SEP IRAs, simple IRAs, generally speaking, the backdoor Roth is probably not going to be available in terms of doing it in an efficient and desirable way. So what do? That person probably just says, okay, I'm going to invest this $7,000 or $8,000 in a taxable brokerage account. And that's not that bad of an outcome. But anyway, so you just got to look at your own situation. But absolutely, the backdoor Roth can be a desirable path.
So guys, quick question and sort of clarification on deadline. So what other accounts have the April 15th deadline versus the end of the year deadline?
So just like the traditional Roth IRAs, the HSA, the health savings accounts, also has the April 15th deadline. Without getting into too much complexity, I will say that contributing to an HSA through payroll is a better bet, just because you're avoiding the FICA, the payroll taxes on that contribution, as well as the income taxes, so that the Medicare, Social Security, up to the wage base. So that's actually one of the add-ons I had here for year end is, one, if you have any year-end bonuses, you might want to look at your plan, your 401k, 403b, et cetera, to see if that's considered what they call eligible compensation, which means maybe you're behind on maxing out your contributions through your 401k. Maybe if you have a year-end bonus, just see, hey, is my elective percentage for contributing to my 401k, will that also include my year-end bonus as eligible compensation? Because that might help you get over that, just max out to the top of that. Like Sean said, if you might want the IRA and the HSA, if you're kind of saying, hey, which one should I focus on? Really, the year-end deadline is on those workplace retirement plan contributions, assuming you're an employee, right? If you're self-employed, you have some extra time to do those things. But if you're like a W-2 employee, you want to prioritize focusing on your workplace retirement plans. And then April 15th, that is the deadline for your traditional Roth IRA contributions and your HSA contributions.
If you take an extension, does the deadline move to the extension October 15th?
It does not. So it's the April 15th filing deadline without the extension for those IRA and HSA contributions.
Okay, and one other hack that I do that folks that work their way toward this can do is I lump sum my contributions for a backdoor Roth and an HSA in January of that year so that they have a whole nother year to 14 months of growth that you wouldn't have necessarily with a dollar cost average approach. So I did a dollar cost average approach, but it was pre-saving for the next year. So I worked through that. And then going forward, I'm just paying myself in a high yield savings account next year's contribution for January.
Yeah. I'll just quickly add to that. One important concept is if you do make the HSA contribution at the beginning of the year, just make sure that you're covered by a high deductible health plan through the entire year. Otherwise, you might have a prorated excess contribution you have to take out if you end up switching retirement plans to a non-HDHP. And yeah, going into that, anytime you do something at the beginning of the year, IRAs require earned income, right, from employee or self-employment. But HSA contributions, maybe kind of something we'll highlight in the phases of retirement, an HSA contribution does not require earned income. So if you're covered by that high deductible health plan, that ADHP, you do not have to have a job to contribute to it. So let's say you retire at the end of this year, 2025. Next year, assuming you're covered by one of those plans, we'll maybe talk about what that looks like in 2026. But you do not need earned income to contribute to an HSA, which is fantastic, whether you're an early retiree or on the path, assuming you're not covered by Medicare.
Well, I have a hack that I just discovered this year because my kids turned 26. We're insured with Farm Bureau, which has great rates. Not all states have it, but we pay under $1,000 a year for premiums for a family of 4. We did up until they were 26 and get great high deductible benefits. We unfortunately got to test this last year with some major health issues we had, and it worked out great. But my kids at 26 migrated off that plan, and the Farm Bureau allowed them to grandfather into that plan. So now for a very low cost, I think it's $120 a month, we're going to carry that forward for them, because if they exit that plan, they can't get it back. But that plan allows them to max out an HSA or we can max it out for them and they don't have to have earned income. So there's an HSA hack that Jackie probably hasn't talked about.
Yeah, I've heard you talk about the Farm Bureau health insurance before, and it sounds like a great option. I wish it was available in all states. I've been trying to dig into how available is it, and it doesn't seem like it's widely available. So if it's in your area like you, it's worth digging in and seeing, if you're listening to this, see if that's something that is available to you, because that could be a really great option. For me in Ohio, it was not available, but I mean, look at how much you're saving on health insurance.
The way I looked at it, my kids aren't going to stay in their first jobs very long. Say they lose a job, say they exit a job, rather than having to bridge that gap, they'll always have a high deductible plan in the background. And it's low enough cost that they can pay for it, or we can pay for it. Maybe it'll enable them to save more if we pay for it. But they don't have to go on COBRA, which is high cost. And so we have a backstop, and they can have 2 insurance plans if they have good insurance at their employer. That was something I learned this year that I hope helps our audience. Hey, Jackie, guess what? We got a new sponsor for the show.
Yeah, I am very excited about our sponsor, thealloymarket.com. It came to us through our partnership with the Financial Influencers Network. And what they do is help amplify the stuff that we're talking about and getting us with great partners like the Alloy Market.
Yeah, the Alloy Market has a great story. The founder had a medical emergency, needed to take a break from his job, but needed to keep himself afloat. He had some inherited gold and silver or platinum. He sold it, but he wasn't sure how to do it. He didn't know where to go, and he's not sure he got good prices. The Alloy Market buys your gold, silver, and platinum for excellent prices and helps you declutter.
Yeah, that is so cool. So, Bill, I am going to put this new sponsor through the test. So I forgot I had this little gold bar. About 10 years ago, a friend gave this to me, and it's 2.5 grams. So I am going to go online and get the kit that they offer and see how much I can get. Supposedly, they give you a lot more, at least 70% of what the spot price is. So I'm looking forward to that. But a long time ago, Bill, this didn't exist. And my old wedding ring, I had that thing around forever. I'm all about decluttering. So when I finally got rid of it, the only option I had was to go to like a pawn shop or something, sometimes a sketchy part of town. I don't even know if I got a good deal. So I am looking forward to Alloy and checking out their process. And you should probably check it out too.
Yeah, Jackie, we're very happy to have the Alloy Market as a partner. I look forward to finding out how your test goes.
Yeah, just go to thealloymarket.com. That's TheAlloyMarket.com. So you can do the same thing, and I will give you an update on what I got for my 2.5 grams of gold.
Yeah, that's thealloymarket.com. That's TheAlloyMarket.com. Look for it in the show notes. Jackie, did you have any tax tips for the end of the year with regards to health insurance or whatever that you wanted to talk about?
I think the guys covered it pretty good. The main things that were on my mind was some of the things that was in the tax law, the one big, beautiful bill, and the fact that this has been all over the news. Every time you go online or you turn on the TV, they're talking about the expiration of the enhanced tax credit. So that's obviously going to impact me because I purchased my insurance off of the exchange. And November 1st, which this should air after that, so we should be able to see what the costs are. But right now with the shutdown, that's one of the negotiating points. So that's a little bit scary. But one thing I wanted you guys to talk about a little bit that was in the bill was, and this will be going into 2026, but catastrophic and bronze plans now. You can have an HSA. Sean, I think you may have dug into that. Can you kind of flesh that out for us?
Yes, so great point, Jackie. As we record this, they're still in the so-called government shutdown, so there's still I's to be dotted, T's to be crossed. We don't have the full picture from today versus when this episode drops versus New Year's Day. But what we do know is in July, the One Big Beautiful Bill made an interesting change to ACA plans. What it said was all the bronze plans and all the so-called catastrophic plans starting in 2026 will qualify as high deductible health plans. So that's a fancy way of saying in 26 and beyond, if you're on a bronze or you're on a catastrophic, bam, you qualify for a deductible HSA contribution. And I've jokingly referred to that as bronze is gold, because what you could do with that deductible HSA contribution, if you're an early retiree, say, or you're self-employed, you make the HSA contribution and you take a tax deduction for that, great. You also get to remove that from your adjusted gross income, meaning that you might be lowering it such that you qualify to get under the 400% of federal poverty level cliff, which as of this recording is still in effect for 2026. Or maybe you're already below it, but great, you now increase your premium tax credit. So it's a deduction that then helps with the premium tax credit, and it creates a tax-free pool of money. So if you actually have the sprained ankle or some other medical expense, great, whip out the HSA debit card and use it, because the alternative might have been to have sold a capital gain asset to fund that medical expense. That triggers more income, lowers premium tax credit, or maybe taking it from a traditional IRA. Well, no, you have this tax-free pool of money. The other thing I'm going to mention is these catastrophic plans. Usually, up until this year, they've really been mostly available for those under age 30, so not really the early retiree. Well, in September, Health and Human Services came out with some new guidance that sort of didn't get any press. I found out about this from a commenter on my YouTube channel, so thank you very much. What they did was they said, okay, starting in 2026, if your income is above the 400% of federal poverty level, we'll consider that an eligible hardship so that you now qualify to go on one of these catastrophic plans. And I think it's worth looking into. Now, I will say this. My initial inquiry into this, and it wasn't very deep, what I initially found is the difference between a bronze and a catastrophic is your premium might be 25 or 35% less, something like that. That's the general ballpark, and your mileage absolutely may vary. I was hoping, maybe it would be like 60 or 70% less. And then it's like, oh boy, maybe we should really consider this. So I don't know that the catastrophic is going to be the be all and end all if your income is above that 400% of federal poverty level, but it's absolutely worth looking into. And I will say, when we're marketing things, using the term catastrophic is probably not the best way to market them. And technically, the idea is it covers your catastrophic costs, and it can be a lower premium. So yeah, there's definitely some balls in the air, but I think bronze in particular deserve looking into because of this HSA rule that's going to come into effect in 26.
Well, Jackie and I believe that everybody should have access to an HSA regardless of plan, and it should be universal. Hopefully, we work towards that solution where the nation has access to it, and you don't necessarily have to have a high deductible plan because health costs are so high, and this is such a valuable account. Give consumers and taxpayers a little Benny, I would say.
Well, Bill, if we're going to make votes here, one thing I would love to happen is imagine if HSA contributions were limited, but they were limited at your out-of-pocket maximum, right? So let's say you have like a $12,000 out-of-pocket maximum for a family. I believe, again, this is opinions here, that I believe that you should be able to make an HSA contribution to that amount, right? So that at least that your maximum out-of-pocket for health cost are at least deductible, et cetera. So yeah, but yeah, I think as Sean mentioned, that word catastrophic, it doesn't mean it's like an awful plan. It's really just protecting you from the catastrophic. Just my bias here is I think that everybody should have a maximum out of pocket for their health costs, because that's something that can really crush you if you just have a kind of unlimited health cost, whether you're in retirement or not.
Yeah. Are there any hacks? Because everybody worries about the premium tax credit, and Jackie's really good at hacking this. What are some common hacks or concerns that might push you over the limits to not get your tax credit? Let's address that real quickly.
Yeah, Sean, I was kind of thinking if you want to move into the kind of the first phase of retirement, that actually plays into the use of HSA reimbursements, those tax-free reimbursements, as Sean calls them, PUCME, those previously unreimbursed qualified medical expenses, PUCME. Also the use of Roth IRA distributions. So we've been kind of hearing everybody's so focused on tax-free long-term growth with these HSAs and Roth IRAs, but using a Roth IRA distribution, especially if assuming that in early retirement, you're just taking back your contributions tax penalty free or reimbursing yourselves tax-free from the HSA. Let's say that you have a spiky expense in retirement, such as medical or otherwise, or even pre-retirement, that maybe taking this tax-free money earlier is actually better than later to not spike your income. And as you're moving into early retirement and you're focusing on reducing your health premiums with the premium tax credit, actually pulling money tactically from a Roth IRA or HSA tax-free can actually kind of help you keep yourself from boosting up above that cap that's currently in place.
Cody, thanks for mentioning the Roth IRA, because I was beating myself up for taking out Roth IRA dollars. And again, it's the contributions. You never have to pay a penalty. There's no age or anything, just on the contributions, not the growth. And that's sort of exactly what I was doing. I have since set up a 72T, but that's exactly what I was doing. And I started taking money out of the HSA. And like you said, this is kind of like the first phase where right after you retire, maybe you're in your 50s or something like that, this is the things that you want to think about. And I certainly had to consider all the things you just mentioned.
Yeah, let's circle back for a minute and dig into drawdown. We jumped ahead to puck bean. I love that expression. But general drawdown principles, you're trying to take the fear out of the RMD tax bomb at Ed Slott. You're trying to take the fear out of the widow's tax trap, the IRMAA tax surcharge, Medicare B&D premiums. There's a lot of things that people are very afraid of and try and optimize for depending on their own situation. But what is really the impact on your life experience? Should we be afraid of these things? And what principles do we follow to, number one, we could avoid these things, but if we can't avoid these things, like I might be in this situation where I can't do Roth conversions given the age of my retirement and income, and I'm going to hit IRMAA, I'm going to hit the RMD tax bomb, I'm going to hit the Medicare premium increases, which I can thankfully pay for with an HSA. But on your drawdown principles, you always talk about the compelling three: pay taxes when you pay tax less, and then using data to allay fears of taxation in retirement. I mean, you use tax returns to show us, yeah, this is really the impact of these fears, and it's not as much as you think, and it might not really affect your life experience. So you're a bit contrary to the fear-mongering in the financial services industry about the tax bombs that we all face. But you talk about number one on your drawdown principles, focus on taxable accounts first. Take us through your thoughts on that.
Yeah, so Bill, a few thoughts on that. First of all, what's happened over the last decade and a half is a lot of folks have promoted what I call inchoate fears. So notice when they talk about you need to do Roth conversions, RMDs are really, really bad, IRMAA's bad, widow's tax trap. Ask yourself, the first question you should ask yourself is, where are the numbers? Right? And my experience in viewing and reading personal finance content is a lot of times folks will say, oh, these RMDs are going to be terrible, or you need to do Roth conversions. But they don't back it up with any sort of numbers, or only very limited numbers. So I think that's an interesting observation. And what it promotes is inchoate fears. You know there's something that's not positive, but you don't have a way of measuring it. So boy, it becomes this bigger and bigger and bigger and bigger boogeyman, right? All right, well, let's step back. What tends to be true is most retirees are going to be lightly taxed in retirement. I know that's a contrarian message, but what tends to happen is the Internal Revenue Code, our tax laws, tend to like retirees. Now, is that 100% universally true? Of course not, right? But what tends to happen is the retirees that our tax code does not like tend to be very financially successful later in their retirement. And those retirees are in the best position to bear tax risk, right? So essentially what's going to happen is it might be that if you are very financially successful and you use traditional retirement accounts, you might get to a point in your later years where you're paying a 32% marginal rate on some, certainly not all, some of your required minimum distributions. Well, okay. Can you bear it? Yes. And in fact, that's the best time to bear it, right? If you're paying that 32% when you're working and you got 2 kids, that could be a challenge. If you're paying that when you're 60 and you just retired, well, now you're increasing expenses at the front end of your retirement when you're at more risk for things like sequence of return risk. I'm getting excited and mixing up terminology, but all right, sequence of return risk. Is it a huge thing for well-diversified investors? No. But is it nothing? No. So why have these huge tax expenses at the beginning of retirement if it's at least something to consider? Okay. So then you say, well, all right, I'm hearing all that, Sean, but how does that translate to tactics? And in our drawdown, if I could only give you 4 rules for your drawdown, and that's it, and we can't discuss it ever again, I would give you these 4 rules. Now, there's going to be plenty of divergence and tangents off these 4 rules, but let's start with these as a framework, and then we could talk about tangents. So the first thing is spend the taxable accounts first. The cool thing about taxable accounts is really 2 things. One is basis recovery. So, Bill, you and your wife invest in broad U.S. index funds. Okay, great. And they're in their taxable account. You're going to retire in 3-4 years. Okay. Well, those things are most likely going to grow. So then you get to a retirement year and you say, hey, we need $100,000 to fund the next 6 months of our retirement, just living expenses, travel, food and beverage. Okay. So you go into that mutual fund, you sell $100,000 worth of it. Well, how much of that is your taxable income? Well, we know it's $100,000 less some number, less your historic cost, your so-called basis. So that's a really good way of arranging your affairs because your living expenses are, say, 100, but your taxable income to fund those is some number less than 100 because of basis recovery. But it gets better. All right, but there is a gain. Well, if you can keep your income really low, that income might be taxed federally at 0%. And oh, by the way, you live in Tennessee, so the capital gain will probably not be taxed either, right? So it might be that some or all of that gain is 0% income taxed federally. So when we combine basis recovery with the 0% long-term capital gains rate, 2026, by the way, for a married couple filing joint, $98,900. If your income is below that level, all your long-term cap gains go off at 0%. So that's very powerful. So that's the first thing. Spend the taxable accounts first. Second, when the taxable accounts get depleted, switch over to the traditional retirement accounts and you live off those. Okay, well, that's fine. I mean, you're going to create taxable income, but because of our high standard deduction world, that might be very low taxed. You might have some of that go out as what I refer to as a hidden Roth IRA. You take money from the traditional IRA, it's offset by the high standard deduction, maybe the senior deduction, and all of a sudden you took money from a traditional retirement account. They say that thing is full of tax, but you paid 0% on a piece of that. That's pretty helpful. So that's our second rule for drawdown. Taxable accounts first, then traditional retirement accounts. Third thing is delay Social Security claiming. Look, if you can't afford to, then take your Social Security. Guess what? You're not going to have tax problems. You might have sufficiency problems, different conversation. But delay Social Security to age 70, particularly for the higher earner or a single person. This increases the future Social Security annually when we're in our 70s and our 80s, provides more stability then. But it frees up your 60s for more tax planning. It could be Roth conversions. It could just be taking traditional retirement account distributions against things like the standard deduction. Either way, that can be very impactful. So that's our third rule, delay Social Security. And then our fourth rule, use our HSA, what I've referred to as PUCME previously, unreimbursed qualified medical expenses, and or Roth accounts strategically and tactically. So what do I mean by this? Take them maybe to fund a new car purchase so you don't go up a tax bracket. Maybe take them when it'll help increase your premium tax credit. You have these tax-free pools, and in the personal finance space, we've focused on building them up, and that's great. But now it's time for us in the personal finance space to start thinking about, well, when do we take those things out? Everybody loves to have $1 billion in a Roth IRA, and there's nothing wrong with that. But we do want to start thinking about tactical, strategic distributions from those accounts when they can be most impactful. Maybe it's to optimize for premium tax credit. Maybe it's to fund the new roof replacement or the new car or something like that. So those would be the 4 rules. Taxable accounts first, traditional retirement accounts second, delay Social Security, use Roth IRAs and HSAs strategically. And there are plenty of good diversions we can go off those paths. Just because those are the 4 introductory basic rules doesn't mean everybody needs to live by those to the dot to have good results in retirement. But those would be the first 4 rules of drawdown.
All right, so Cody, you love taxable accounts. I know you love taxable accounts. There's a lot of power there. What are the reasons, and you have several reasons in your drawdown principles as to why taxable accounts are first? Can you take us through those, please? And I love the one that you start with, where it's Get Rid of Your Cats and Dogs by Jail Collins.
So yeah, the cats and dogs are those investments within your accounts that you would love to get rid of anyway, right? Those things that are like leaving you like non-diversified, like, hey, I put all my money in this one stock, it went to the moon, and I feel like if this one stock went to zero, I wouldn't have sufficiency in retirement. So yeah, first, if you're going to prioritize which investments to sell, get rid of the cats and dogs, as J.L. Collins mentions, and Sean also reiterates in the book. So I want to kind of step back. There's a common misconception. When you say taxable accounts, they're like, why would I take money out of a taxable account? Doesn't that mean that money is taxable? And again, we have a lot of kind of poor words kind of thrown around the industry. We talked about catastrophic being maybe a bad word choice earlier, but taxable simply means taxable along the way. So what that means is, by the way, taxable means your checking accounts, your bank accounts, your checking, your savings, and your taxable brokerage accounts. When you put money in, there's no deduction. But when you take money out in cash, there's no taxes on the money that you withdraw in cash, right? It's really taxable along the way. That interest, those dividends, those capital gains, those are taxable in the year they're received, regardless of whether you take that money out of the account. So taxable brokerage accounts are fantastic for specifically keeping ordinary income low, or really keeping income low, especially in the early parts of retirement. We want to try to maintain our desired living expenses with as little income as possible to start. And that typically starts by taking money out of our checking, our savings, and our taxable brokerage accounts with what Sean called the basis recovery. What that means, as Sean mentioned, is if I put $50,000 into an investment and it grows to $75,000, if I sell that investment for $75,000, I'm only taxed on the gain, the realized capital gain of $25,000, not the full $75,000 that I took out, that I sold and maybe took out as cash. Whereas if I went to a traditional retirement account, a pre-tax account, and I took out $75,000, most likely all $75,000 of that would be taxable, right? So taxable brokerage accounts, taxable accounts, the checking, savings, taxable brokerage, it gives you the opportunity to get your money to live in retirement with the least amount of tax consequence. I'll also mention, Sean always points at me on this. I love this idea of specific identification. It's called Spec ID. This is a basis recovery option that whenever you go into your taxable brokerage account, let's say at Fidelity, Schwab, Vanguard, et cetera, you can choose specifically which lots you sell. Anytime you purchase an investment in an account, let's say I purchase a mutual fund, it pays a dividend that's auto reinvested. When it's auto reinvested, it buys a new lot. Think about a lot as like a kind of a basket. Each time you purchase, you're buying, hey, maybe 10 shares of this, 5 shares of this, 1 share of that. Each of those are considered lots that have their own cost basis, which is your purchase price, but also has its own holding period, which is short term, which is held for a year or less before selling, or long term, held for over a year before selling. So what's cool about specific identification, Spec ID, is you can go into your taxable account and say, hey, I want to look at how much unrealized capital gain or loss each lot has, and also what's the holding period for each lot. And I'll simplify this and just say, my wife and I just got a new AC, new ductwork put in for $22,000. And I'll just share a fun example that I was able to sell $22,000 of securities within a taxable brokerage account, not adding taxable income of $22,000 to my tax return, but just adding a few $100s, because I was able to find a lot within my taxable brokerage account. Hey, I bought this security, let's say for $20,000, and it's now grown to $22,000. By selling that, I only have taxable income of $2,000 in that example, and that might even be taxable at a long-term capital gains tax rate if I held it for over a year. But this is a very complex subject, but I do want to say that by focusing on living off your taxable quote-unquote accounts first, you're actually able to kind of control and pick and choose your reduction of taxable income. And what's cool is that once you have your expenses met in retirement, you can say, well, how much taxable income do I have? And many, especially early retirees, will look over by taking that general framework and say, hey, I have my $100,000 of living expenses, and I only tapped into taxable income of $10,000. So now I have opportunities to maybe do some small Roth conversions, maybe do some what we call tax gain harvesting, which is maybe sell even more securities intentionally taxed at 0%. Or, as Sean mentioned, maybe I want to be strategic about keeping my income just to the level where I start getting premium tax credits for health insurance, but don't make my income go too high with those exciting Roth conversions and tax gain harvesting that I end up getting no health insurance premiums. Any premium tax credit subsidies. So a long-winded way of saying, yeah, taxable brokerage accounts are great for flexibility while you're working, but they're even better, I think, in early retirement.
Yeah, Cody, I think you're 100% right. If I had to do anything different, I've been retired for 6 years, I would have had a lot more in my brokerage account. I think I had enough to cover 2 to 3 years worth of expenses. And after that was out, my options became more limited. But you just gave a huge example of why that's so valuable. So if you are 5, 10, 15 years from retirement, the brokerage account is going to be something that you want to look at. And I have a feeling that after our whole conversation today, our listeners are all going to reevaluate the tax aspect of their planning because it can be huge.
I want to add just one thing that's really important, though, is just like we get excited about Roth IRAs, we get excited about the flexibility of taxable brokerage accounts. You need to be very careful before forgoing a deduction. So I will say that even though it might feel nice to have a balance between taxable, pre-tax, and tax-free money, having that flexibility in retirement, it's really important to understand the opportunity cost of foregoing a deduction to do that. So I will say with our compelling 3 of accumulation of contributing to traditional pre-tax retirement accounts at work, contributing to the Roth IRAs at home, and then if you have extra available, contribute to those taxable brokerage accounts. Just make sure not to flip the order of operations due to excitement, just because sometimes foregoing that deduction can actually, most people don't do the math to or through retirement, but we will say that foregoing a tax deduction, measure twice before focusing too much on flexibility over tax optimization, assuming that you have some short-term money to meet your current expenses.
Yeah, that was my question, actually, because people talk about, like Nick Bajuli, the marginal gains on a pre-tax account are minimal compared to, say, a taxable brokerage. And he would recommend hybridizing your approach and not necessarily maxing out your traditional 401k in lieu of putting that additional money in taxable. But you're recommending fill that traditional 401k IRA first, and then overflow goes into taxable, because when you run the numbers, there's a benefit, correct?
Well, I think there's a difference between flexibility and tax optimization. I think they kind of get muddled here. That when you're working, let's say that I'm 30 years old, just got married, maybe a kid on the way, right? I need flexibility, like my emergency fund, like things like that. Like I probably want to build up some checking, savings, taxable brokerage money for life, for the emergency fund, for maybe like that down payment for the car, right? You probably don't want to be tapping into your 401k. By the way, a lot of times if you want to tap into your retirement accounts while you're still employed, there's usually restrictions to taking money out, unless there's a hardship, which can still be penalized, et cetera. I think flexibility is important when you're building up wealth, especially starting off. Like me, when I was 30, I had nothing built up. I'm 37 now. Now I have some flexibility by building up some taxable brokerage accounts for just life. You're buying the new car, the down payment, et cetera. But once that flexibility is met, especially while you're working, then I flip into tax optimization. Certainly, I wasn't saying no. I definitely still took advantage of the employer match at the 401k while building up flexibility. But once I have that flexibility, especially while I'm working for those short-term objectives, then I really focus on tax optimization. And I'm very careful not to just say, oh, well, I've been told I need Roth money or I need taxable assets in retirement. I'll say that that need is actually overblown, and that you really need to be careful before foregoing those big deductions. It's funny, if you actually end up in retirement with no taxable income, that can also be a problem because you're not able to fill up, even get to the place of having the premium tax credits and some of those things. So I know Sean will definitely go even further with this.
Well, so I have a lot of respect for Nick Bajuli. He's written some really good stuff. But I think this particular argument misses something that's huge, which is median adult wealth in the United States, right? So the median, right, not average, 50% above, 50% below adult wealth, according to UBS Bank, is around $125,000. That's median wealth in the United States. So the median person is catching up to FI. And at that level of wealth, even if it was all in traditional retirement accounts, you will never have a tax problem. That will be very, very, very lightly taxed, even when you're taking Social Security. So what we need to prioritize is catching up to FI from a sufficiency perspective. And the quickest and the cheapest and the best creditor protected way to do so is traditional 401k contributions at work, right? Essentially, the median adult in the United States is behind in their sufficiency. So we have to make it as cheap and as inexpensive and as convenient as possible for him or her to be able to get to a sufficient financial retirement. And the quickest and the cheapest way is to take those deductions at work into our traditional 401k.
I couldn't say it better. That's a strong statement. I don't think we could say it better. And it's so important for late starters, where there's a lot of FOMO about all these accounts you should contribute to, and it becomes kind of a mess. You've made it very simple, and our late starters appreciate that.
So, Bill, in the book, there's an example, Justin and Rachel. And it's a fun little example. They're 53 years old, and they retire. And they didn't do the quote unquote compelling 3. They did like the compelling 1.2. They had 2 years of taxable brokerage accounts, like 140,000 in a taxable brokerage account. And then it's like 2 million in a traditional 401k or 401ks. And that's it. And that's enough for them to live. So they essentially have the first 2 years, they just draw down the taxable accounts. Great. And they pay no federal income tax in those years. They might even do some Roth conversions and pay no federal income tax. But then after that, they're 55, and the only thing they have is the 401ks. So they start one or more 72Ts, and their effective rate is in the single digits from 55 until 70 when they start taking Social Security. I was joking on another podcast with Jordan Grummett. Is it malpractice for us not to be recommending that path? No, it's not, by the way. But I bring up that path to just show that, yes, we love these taxable accounts and they're fantastic, but they're not necessary, right? Necessary is a word that's sort of overused in the personal finance space. There are ways to get to financial success and tax planning success that might, at least initially, look inefficient. But you guys actually had 2 episodes about the 72T plan. Linked to that back in the show notes. But 72Ts, are they perfect? No. But can they be very good? Yes. And they're a perfectly valid planning technique in today's environment.
Yeah, I think it's a great technique for somebody in their 50s, just like Jackie did to reach 59 and a half. It's a great way to bridge, I think, for 5 to 10 years.
That's exactly what I was going to say, Bill. Yeah, so Sean, honestly, the content that you were putting out on 72Ts, which is equal periodic payments, that's a rule in the IRS code that allows you to take money with regular payments out of your traditional retirement account and not pay the 10% penalty. You were one of the early people that I knew talking about it. You showed in a Google sheet how you could do the calculation. So I have to thank you for that. And it put me down a rabbit hole. And it did result in us having a mega 2-part series about 72Ts. So if you're like, what the heck is that? We will link to that in the show notes. So you can listen to all about it from soup to nuts and everything. And I love that example that you put in the book. It really hit it home.
I just want to share some interesting math. Let's look at some real numbers here. I want to share a really interesting kind of idea about the difference between contributing to a retirement account versus drawing down. You want to go for a single or married filing jointly in this example? Or both?
I'm married, but Jackie's single. Maybe you better do both.
Yeah.
Quickly.
So I know, no missing out. So this is really interesting. So let's say that there's a single taxpayer, a single worker in 2025. They're under age 65, right? They're working hard, and they have to get to a place of having a marginal tax rate. So where their highest ordinary tax rate is 22%. They hit the 22% tax rate with adjusted gross income of only $64,200. So let's say they retire the next year and they only have traditional retirement accounts. So they deducted into that account at 22%, right? So let's say they made 100,000, right? And they contributed to a 401k. That was all deducted at 22%. How much money would they have to take out of a 401k IRA in retirement if that were their only source of income? How much would they have to take out of that account for them to hit, let's say, a 20% average effective tax rate?
I'm going to defer to Jackie on that one.
Well, I was going to say you have to consider the standard deduction that they get and probably some other factors, but do tell.
Well, it's interesting. So they saved 22% on their deferral when their income was, in this case, $100,000. They will not hit a 20% average tax rate until they've distributed over $233,000 from that retirement account. So somebody who made $100,000 contributed, say, $25,000 to a retirement account, and then they go into retirement, they'd have to pull over $233,000 from that account as their only form of income, like having no other flexibility to have a 20% tax rate. And this is even crazy. If you think about, that's the single number. Let's say that a married couple filing jointly, they're in the 22% bracket while working. And let's say they're making $200,000, double, right? They're deferring those traditional 401k contributions at 22%. Then they retire. So they went into the 22% bracket while working once their AGI hit about $128,000. When they retire, again, they're under 65. They don't get additional standard deductions. They don't get the new senior deduction. They would have to pull over $466,000 out of that retirement account to have an average effective tax rate of just 20% on that money. So I think we have to be careful about when we're working, we're deducting income from the top of our bracket. Whereas when we're retired or distributing or converting that money to Roth, we're going from the bottom up. So while you're working, you're deducting top down. And when you're distributing or converting, you're going bottom up. And I think that that simple fundamental framework is often missed.
No, that's a critical point, and that's something I learned from your book. There's these overriding concepts where we think where we are now and our tax rates now is where we're going to be in retirement, and it's inverted. In inverting it, you're not getting hit as much as you think you are while you're accumulating. They're totally different rules, and we have to get our heads wrapped around the fact, like you do in your book, that, you know what, the rules work to our advantage. Even if we don't have Roth, even if we're all traditional, you guys have a great message. And other drawdown principles you talk about that we may want to touch on, take from the older spouse's traditional retirement account first. Sean, you want to take that one?
Yeah, so this is a nickel dime play, right? But it makes a lot of sense. And especially if we have 5, 6, 10 years difference. So we mainly say that for a couple of reasons. One is RMDs, and we can come back to them. There's a lot of fear about RMDs. A lot of that fear is overblown and or misplaced. But reducing RMDs is a legitimate planning objective. And one of the ways you reduce RMDs is by just living off those retirement accounts before RMDs are required. And so if you're going to whittle down 2 different IRAs, say, and one has RMDs in 5 years, and then the other one, because the spouse is 5 years younger, has RMDs in 10 years. Well, you want to start hiving down the one that has the RMDs sooner. By the way, this is a reason why we generally take inherited retirement accounts first, maybe even before taxable brokerage accounts, because they generally are going to be subject to a 10-year rule. So they have like the very first RMDs, and the biggest RMD, essentially, the way it sort of functionally works. But yeah, so we want to live off the older spouse's traditional IRA before we live off the younger spouse's traditional IRA. By the way, if we're going to do Roth conversions, it makes the most sense to do it off the older spouse's traditional IRA first. And then something called qualified charitable distributions, they start when the owner turns 70 and a half years old. So as a practical matter, you're going to be able to access or do those qualified charitable distributions from the older spouse's retirement account first. QCDs are a very powerful tax benefit, very, very powerful if you're charitably inclined and retired. And so we're going to do those first from our older spouse's IRA.
Yeah, it's interesting too. And the sequence of events there is important in decumulation with older first. My wife and I are in an interesting situation where we're both independent contractors. We both have solo 401ks. She doesn't hit the max in her account, but her balance is smaller than mine. So I risk forward in her account. And if I want to rebalance, put bonds, I de-risk in my account because it doesn't need to grow as fast, which functionally will reduce our overall RMDs because my account won't balloon, but hers will. So when you're hitting the gas pedal, focus on where your risk is. I mean, you could be 100% equities in both, I guess, and blow it up. But if you're balancing it, really hit it hard with risk, I think, and the spouse that has the lower balance in their pre-tax IRA. I think we've talked about this before, right, Cody?
Yeah, I think so. If you're having to like pick and choose, if you can't max out both, I think it is really thoughtful to say the whole reason about kind of taking out the older spouses first is really that we want as much control as long as possible, right? Is that we don't want forced income as long as possible. So also you mentioned a tactic there. We talk about asset location that most people, especially moving into retirement, are going to have bonds, fixed income, cash or bonds in their total portfolio. So if you had to choose which accounts you want the most growth in or the least growth in, right? Typically, on average, generally, we expect bonds and cash to have a lower growth rate than our stocks, right? So if you have the opportunity, you might want to consider holding those bonds in the accounts that you would like to grow less, which would be those pre-tax accounts that have future RMDs. Also, you not only are reducing RMDs, but you're also reducing the need for more aggressive Roth conversions. So maybe a future conversation on this idea of like, do I need to do Roth conversions? I think that word need is much too strong.
Well, I'm in that camp where I probably won't have a big enough window, and we can talk about that window, and I'm not going to be able to do them because of my income. But what I do, and this is not advice, obviously, is I'm growth forward in HSA and Roth, 100% equities. I'm growth forward in taxable, and I rebalance and have the sort of stabilizing assets in the pre-tax accounts. You can put bonds in taxable, and there are ways to do it that it's not a sin to do so. But I agree with you. That is the place, especially moving into retirement, where you rebalance to a lower risk profile to avoid sequence of returns risk and all those things. Right, Sean?
Yeah, I think that's right. So one of the nice things about people ask about, well, is there this ideal, mythological ideal? I have 40% in traditional and 30% in Roth and 30% in taxable. We say no, there's no ideal mythical balance between the three. But the three are very useful for several things, including this idea of asset location. So what you do is you pick a portfolio allocation you want. And when you do that, you don't worry, at least to start, about Roth or traditional, or I got this 403B over here, this taxable brokerage over there. You just say, theoretically, if I looked at my entire financial wealth, how would I want it allocated? And then I can use this asset location technique to do some simple planning. For example, having all our bonds in our traditional retirement accounts and to do reallocation, right? Because we don't want to be doing reallocation for the most part with our taxable accounts because that can trip capital gains. Once in a blue moon, maybe there's a taxable loss in there. Great, do that to trip it. But for the most part, we do our reallocation inside our traditional retirement accounts because we generally have a good amount of runway in there to do it. And holding these bonds in the traditional retirement accounts has, one, it keeps that interest income, which could be 3%, 4%, 5% off our tax return every year. That's beneficial both in accumulation and in retirement. And then two, the term I'm going to use is expected return, right? From an expected return perspective, bonds tend to go up less than stocks. That's not a 100% guaranteed outcome, but generally we're going for the growth in our equities. So parking our bonds in the traditional retirement accounts has this second great consequence, which is it helps keep those things lower, which helps from an RMD planning perspective. And that's part of the reason we're not all that fearful about RMDs. There's so many different ways to attack that quote unquote problem, right? If you perceive it to be a problem, okay, there's different tools in the toolbox, and you start figuring out, wait a minute, there's a bunch of different tools in the toolbox. Why am I so worried about something that has all these different remedies available to it? So great question, Bill.
Yeah, I mean, again, fear-mongering inhibits our ability to look at opportunities for planning and adjustment based on our individual situations. And you guys drive that point home in your book. Another thing you talk about in your general principles of drawdown is something that I found interesting and hadn't heard much about. It was number 8, blending distributions. And Cody, can you first take us through that a little bit? Because I think that's going to be a common issue in our audience.
Sure. It's actually related a little bit to what we've said before, this idea that even though we have a general order of operations of going taxable, pre-tax, tax-free, there are opportunities where, let's say you're at the top of the 12% bracket and you're about to go from the 12% to the 22% marginal tax bracket, right? So maybe you have some taxable, maybe you like run out of opportunities there. Then you move over to the pre-tax, but then you're right at this place of having a potential spike into a higher tax bracket. So really looking at all three is not, even though you have a general order of operations, you might say, even though I'm starting with traditional, I might do some Roth conversions from the pre-tax, but then I don't want to go over that. And I did my Roth conversion and now I have this like unexpected expense right at the end of the year. I'm going to maybe go ahead and pull from the HSA, the Roth IRA. So I think even though we have a general order of operations, it's important to just consider, hey, like even though there's a general order, like that doesn't mean you can't kind of make a hybrid scenario based on your own individual circumstances, that you might pull from different accounts strategically, tactically, but it always comes back to the plan, right? This isn't something where you don't choose your hybrid before life happens. Really, you fit your money into your life, not your life into your money. So yeah, Sean, anything to expand on that?
Nothing in particular on that one. I think there's so many good options available, and it's all about getting over the inchoate fears. And it's about, well, wait a minute, there are different ways I can do this. Many of them are relatively simple, right? We talk in the book about a little more advanced techniques, like we call it tailored taxable Roth conversions. But I think at the end of the day, the education on this is not PhD level. We're not splitting atoms here. There are certainly different things you can do to have very good outcomes, even if you did, quote unquote, everything wrong, like some of the financial planners will say. I've heard, oh, you have $500,000 in a traditional IRA. What a terrible thing. I say, well, wait a minute. It might be terrible because you might not be able to afford your retirement, but from a tax perspective, that's a great thing. You're not going to pay a whole lot of tax on $500,000, just the way the numbers work, because it's dribbed and drabbed out every year. So, yeah, I think it's just time to start getting educated and look at a few numbers and figure out, like, okay, there are different levers I can pull to have very good outcomes.
We're used to getting a paycheck. That pulls into our account, and that's one source of income. Maybe it's W-2, maybe it's 1099. There's different sources of income, but you can manage your income in retirement. You can pull from strategic accounts. You can pull from assets in the proper location that have appreciated in order to forward rebalance. And you've got to look at all these balls that are in the air, the complexity of drawdown, and you can try and maximize like the FI community does to the 99% level. But as Jackie says, the enemy of perfect is good enough. And what you guys talk about too is you can do really well and good enough, and the penalty you might pay for a tax bomb or a widow's tax thing, when you look at your book and you look at going through these tax examples and stories, is relatively minimal, and it's not going to affect the quality of the best life you're going to live, right?
Yeah, so that's the thing. All these fears about, wait a minute, you're going to pay a lot of taxes in retirement, they materialize when we have very high balances in traditional retirement accounts. And we have an example where it materializes for a woman who's 80 years old, she's a widow, $4 million in a traditional retirement account, and she's taxed on a $200,000 or almost $200,000 RMD, required minimum distribution, and about a sixth of it is taxed at 32%. Let's say they built up that 401k during their working years. They were deducting at 24%. Now a sixth of it comes back into income at 32%. So this widow's tax trap boils down to a small IRMAA charge for her. Okay, that's not fun, but it's not going to have anything to do with her lived experience or financial success. And then on the income tax side, there's a very small net investment income tax in that example. Okay, fine. That's less than $1,000. And then on 1/6 of her RMD, it has an 8 cents on the dollar inefficiency, right? To be fair, it's an inefficiency of 8 cents on the dollar on $1 out of $6. We're starting to slice the onion real thin. And so this is the widow's tax trap. This is the bomb I'm supposed to be worried about. And oh, by the way, she's 80 years old with a net worth in excess of $4 million. She's done fine financially. And this tax inefficiency is necessarily accompanied by an incredible financial result. So if that's the trap, maybe we want to be in the trap. Now, I'm not saying this woman shouldn't have done some Roth conversions or more QCDs. Let's look at some of these inefficiencies. I think this brings out a big vocabulary issue we have in personal finance. Difference between needed and beneficial. For that woman, $4 million traditional IRA at age 80 in the widow's tax trap, a Roth conversion maybe in her 70s, maybe while her husband was still alive, could have been beneficial, right? Absolutely, 100%. Is it needed? No. That's the key distinction. Things like Roth conversions, for all the hype around them, yes, depending on your numbers, they can be beneficial. But are they needed? Generally speaking, no. No one's going to have financial failure because they failed to do a Roth conversion. Now, there are times when you're trying to qualify for a premium tax credit, you have abnormally low income. You could argue those are needed Roth conversions, and that's fine. But we have to step back and say, for all the hype, the best descriptor is beneficial. It's not needed.
Okay, this is great. Just because you break up retirement, and we've talked about a lot of these things, I think, already, but you break up retirement into 5 phases. I think this is a great construct, too. Your first phase is retirement through 65. Your second phase is the golden years, as you refer to them, ages 66 to 69. Third phase, age 70 to the start of RMDs, which for me, I think is 75. Phase 4 is your RMD years, the tax torpedo years. And then phase 5 is your widow's years or widower's years with that tax trap. Those are interesting phases. Maybe you can alternate through them and just give us a construct of why you broke them up that way and what are the opportunities and challenges in each of those phases.
Yeah, so first phase, the big challenge is going to probably be premium tax credit, just because that is a squirrely issue and can be worth thousands of dollars a year. So that really matters. So we're trying to keep our income low. And that argues for being very conservative, maybe 0 Roth conversions, because we don't want a Roth conversion to cost us thousands of dollars in a premium tax credit every year. So that's the first phase. We're managing mostly for premium tax credit, trying to keep our income low. There are some people in that phase who are not in an ACA medical insurance plan, and they may want to do Roth conversion. So that's phase 1. Phase 2, golden years. This is the world is your oyster time, because you don't have to take Social Security, and we generally favor delaying. You don't have to take RMDs, just that there, and you're not managing for premium tax credit. So this is the time where what we refer to as tailored taxable Roth conversions, where we're essentially trying to do Roth conversions against the available deductions, generally the standard deduction and the senior deduction. This could be a great time for some Roth conversions. Or if we're now living on the traditional retirement accounts because we ran out of the taxable accounts, okay, shelve those Roth conversions, just draw down the retirement accounts by just living off of them, great, and our taxes are probably going to be very good. 70 to RMDs for most in the audience born in 1960 or later, this is a 5-year window, 70 to 74. And here we have to take Social Security. So our planning opportunity is more limited because we're going to have income filling in that standard deduction, maybe the senior deduction. But we could do things like QCDs, for example. So here's where we can start giving to charity through our traditional IRA, get a great result because we're going to get a synthetic charitable deduction plus the standard deduction. By the way, the QCD, or maybe even taking from a Roth IRA, might lower the tax on our Social Security. The funky thing about taxes and Social Security is the tax on your Social Security is mostly dependent on your other income. So this might be a time for a Roth distribution to keep our income low and maybe not have up to 85% of that Social Security taxed. Fourth window is the RMD years. This tends to be very manageable if we're married, because we just get to run up the married filing joint brackets. We get the married filing joint standard deduction, senior deduction. We do QCDs. I generally don't favor Roth conversions at this point because we already have the RMD. We're already whittling down that account anyway. So this is a more conservative time, but QCDs can be very impactful. And then at the first death, if we're married, after that, we're in our 5th phase, the widow years. And these years tend to have the most IRMAA, the highest taxes. But 1, it's still very manageable. And 2, the tax might be hitting at a time we can most afford to bear it. If we're paying a 32% rate at that time, that means we are wildly financially successful. And by the way, at this time, we tend to be older, a lot older, and so we're not looking to spend a lot. Now, you might say, well, what about long-term care? Well, okay, that's a whole other conversation. But what might happen is in this time, you might go into long-term care. In many of those cases, most of those expenses are going to be qualified medical expenses. And so what's going to happen is your last expenses are 92.5% tax deductible. There's like a little funky thing where they disallow some of the medical expenses, but most of them will count. And so you'll be bailing that money out of the traditional IRA to pay the assisted living, institutional living, whatever that is, pay the long-term care and you take deductions on your tax return, and it's the last money you ever spend anyway, sadly, you have a very efficient bailout of that money. So those would be the 5 phases, and we basically define them because of the planning parameters that are around each of those 5 phases. They all have challenges, they all have opportunities. We would argue that, generally speaking, you're doing these Roth conversions because of harmful effects of taxation in retirement. And I think our book and its examples sort of demonstrate that usually you don't have that many very harmful financial effects from taxation in today's American retirement income tax environment, even with IRMAA, even with net investment income tax. And you can use strategic order of operations from withdrawal perspective, right? One of the reasons we like taking those taxable accounts first, it's a way to not pay taxes on the dividends. We have an example in the book where somebody's 60 years old and they say, well, I'm worried about the future taxes on RMDs and whatnot. So they take traditional retirement account distributions first, and what they do is they turn on taxation on the dividends in the taxable portfolio. If they just spent down the taxable portfolio first, those dividends would have been in the 0% bracket. So there's all these little levers that you can pull that are not rocket science. Spending down your taxable accounts first instead of your traditional retirement accounts, not rocket science, but it's a way of keeping your taxes lower early in retirement, and eventually it's going to help you reduce your RMDs because eventually you're going to be living off those traditional retirement accounts. How many of us are going to get to age 75 without needing to spend at least some of our traditional retirement accounts? So our own living expenses are going to help manage for this perceived problem that doesn't tend to be that impactful anyway. So several thoughts there.
Yeah, can you take us through some of the additional items? I agree with what you said, Sean. It's very impactful. And Ed Slott, this is a smackdown. We're bringing you on with Cody and Sean, and we're going to have a tax bomb smackdown. But Cody, what thoughts do you have on these 5 phases? Because I love how you break it up as sort of opportunities and challenges and navigating kind of the income stream and then your expenses. It's really, really cool. I used to hate taxes. I was scared to death of them. And you guys have brought me back to sort of, you know what? This is fun. Jackie thinks taxes are fun. She loves to pay 0% tax on her income and manages her income every year. She's like nickel and diming the government and according to the rules, playing by the playbook. And then the challenge is for the average investor and the average retiree to understand the rules, because there's a lot of them. Cody, your thoughts on the 5 phases?
Yeah, so just quickly, I think because healthcare has become not just politicized, but is a part of the tax system, right, in both early retirement through the ACA and also IRMAA, one of the big things, I've seen this all the time in the Facebook groups of like, I need to avoid IRMAA at all cost. And it's really interesting. So IRMAA, by the way, these are these Medicare surcharges, Part B, Part D for most people. When your income hits above a certain level, if $1 goes over, you're hit with thousands more in IRMAA, with those Medicare premium surcharges. And it's really interesting to look at the math. So in writing this book together with Sean, I looked at, okay, well, how bad is it from a dollars perspective and also a percentage in the lived experience example. So it's really funny. If you want to be more concerned about the cost of health insurance, it should actually be in early retirement, not in traditional retirement. But yet there's so much focus on my RMDs are going to hit me into IRMAA. And at every level of IRMAA, based on current brackets, IRMAA never represents more than a 3% effective tax, meaning that no more than 3% of your household income is respectively going into your IRMAA surcharges. So if you think about, okay, if you were to break down your income and you say, well, okay, I spend, let's say 20% on housing, 10% on transportation, right? If you kind of think about your budget, how much of your budget represents 3%, right? But yet we're blowing up IRMAA to, like, I think a lot of traditional retirees that I've heard, it sounds like IRMAA is going to represent 25% of your budget. If you go $1 over that, your IRMAA is going to blow up your retirement plan. But it represents only 3% of a household's income. So again, yes, like if you might hit IRMAA, if you have income of hundreds of thousands of dollars in retirement, but it's one of those things you step back and say, hey, like I have sufficient assets. I'm a very financially successful retiree to be paying a few extra $1,000s a year in IRMAA. So I just think that the cost of healthcare from an early retirement perspective can most likely be controlled with those order of operations that we've discussed earlier, having some flexibility with the taxable accounts as well. And then going into the traditional, like into really the phases, starting with phase 2 through the end of life, IRMAA is more of a nuisance tax than something to fear itself.
This is great stuff because people want to beat the government. They want to win the game. We're competitive. The FI community is competitive. It's like, let's squeeze all the juice out of the lemon. Otherwise, I'm not going to be nourished. And what you're saying, worst case scenario, say you don't play the game exactly right, but you stick to your big four, as we'll reiterate in a minute, you've won. You really do win without these bennies on the margins of optimization, right?
So for what you guys have done with this book, there's a lot of bucking the trends and going in the opposite direction of what traditional financial planning says. So I love that you are opening our eyes to some of these other things. And because the name of the book has early retirement in it, you're talking about some things that we don't hear talked about, especially not in a well-placed and well put together book like you guys have done. Like you're talking about 72 Ts in a different way. You're talking about HSAs. And I'm wondering what else, like the traditional advice on Roths is one of them that's at the top of my head. But what other things are you guys completely bucking the trend and swimming upstream against what traditional financial planning is typically telling us?
Great question, Jackie. Love it.
Yeah, so I would start with this. Over the past 15 years or so, folks have been conditioned to say, what's really bad? Taxes and retirement. All right, we've been hearing that from all corners of the personal finance space, including the FI community, by the way. The FI community is in no way immune to that. And I think part of what you have to step back and say, are the commentators running the same playbook they were running in 2017? Generally speaking, yes. If you went on, I don't care what personal finance magazine, podcast, Wall Street Journal, right? It was RMD's bad, or taxes and retirement are bad. Well, have there been any changes since the year 2017? Well, one of them occurred very late in 2017, the Tax Cuts and Jobs Act, lower taxable rates, up the standard deduction, but it was only temporary. And you used to hear, oh, get those Roth conversions done before the sunset. Well, guess what? The sunset never happened, right? So it's interesting that we don't go back and say, well, wait a minute, all these commentators were predicting a sunset. Well, they weren't right. The sunset never happened. In 2025, they increased the standard deduction and made it permanent, the higher standard deduction. They made the lower tax brackets permanent. And oh, by the way, they added a temporary senior deduction. Now, I have doubts as to whether that's really going to be temporary, but different conversation. So there was that change. Well, was there anything else? Yes, there was. They delayed twice for those of us born in 1960 or later. They delayed from 70 and a half to age 75 the onset of RMDs. So they took away 4 or 5 of the required minimum distributions. And oh, by the way, they took away the 4 or 5 that were most likely to happen by definition. So there are these commentators saying you got to worry about RMDs. So they're saying you need to worry, but you need to orient your financial planning about a financial concern that only manifests starting when you're 75 years old. How long do you think you're going to live? Why do we have this hyper focus on this one financial planning objective? It's not nothing, but why are we hyper focused on it when for those born in 1960 and later, it's going to affect a very narrow slice of our life and our retirement? So that's another change. A third change that very few comment about is the changes to the RMD tables. The IRS and Treasury sort of snuck this by the goalie, but in late 2020, they proposed, and I believe it was final for starting in 2022, the RMD factors got increased. So they said, okay, you're 75, your life expectancy, we're going to increase that roughly by 7% each year. So that reduced the RMDs. So when you layer on all these things, it's time to reassess RMDs, and our book does that. But I guess my point is, why are so many of the commentators singing off the 2017 song sheet when the world has changed in significant ways? It's time to reassess all this. And I'm not here to say, look, I'm not here to say you never do a Roth conversion. I'm not saying that at all. In fact, I'm saying some Roth conversions are beneficial. I think very few are needed, but I think we need to refocus the vocabulary here. And I think you're going to find that most retirees are relatively lightly taxed. And this goes back to When am I going to pay tax when I pay less tax? Is it going to be during my working years when I literally wake up and be at the office at 9 o'clock to try to earn an income? Or is it going to be in those years where I sleep in and maybe I go on a vacation or 2 or 3 or 4 because I'm retired? We've sort of lost this sense of, wait a minute, my taxable income is most likely going to be at its highest when I'm trying to earn taxable income, not when I'm retired. And look, is that 100% universally true? Of course not. But for most Americans, income on an inflation-adjusted basis tends to go down, not up in retirement. Cody and I wrote this book, I think, to sort of just reorient the discussion. And again, we're not absolutists. We like Roth IRAs when we're working at home. We like some Roth conversions. We fully acknowledge that some, maybe even big Roth conversions can be beneficial with the right numbers. Absolutely. But it's hard to say that massive Roth conversions are needed in a world where retirees continue to face a relatively favorable income tax environment.
Yeah, I mean, Sean, you're 100% correct, because what sells? Blood in the streets, fear. I mean, that's what sells. And you guys are optimists, realists. The sky isn't falling. We're not Chicken Little. Yes, there's things we can do on the margins to improve our lifetime tax expense, but does it make a life experience different? And your conclusion here, holistically, is no. A big, fat no. Right, Jackie?
Yeah, and we love that. And the book is incredibly optimistic, and it's just realistic. Tax is just not as big of a boogeyman as a lot of the pros make it out to be, and a lot of us as individuals have made out to be. My saying is precision is not required. So you can make some of these changes around the corner and on the margin and all that, but it just doesn't have to be perfect. And I finally stopped being so hard on myself when I wasn't doing everything that was optimized. I still turned out okay. Things are still okay. I'm going to survive.
Cody is a trust but verify person, as is Sean. I mean, yeah. Cody, behind him, the sign says measure twice. Don't make rash decisions. Don't make emotional decisions. Use data to back them up. Get advice before. You don't have to do it by yourself. And we've talked about this before with Cody, how to vet a financial advisor. I am getting advice right now. I'm a DIYer. I know many DIYers that get advice, especially heading into retirement, where they make their plan, which is a hard thing to do, by the way, but then they get a second set of eyes on it. And that is money well spent, because there are so many blind spots, so many opportunities. You can't see it all. You can't win the game alone. 1 + 1 is 3. And talking to you guys, I feel like it's 4.
Yeah. That's right. These are just a couple of geniuses here. Cody, I'm going to let you have it there.
Sure. Yeah, I do want to say that the book, I talk about wanting to really measure twice. We have over 120 step-by-step calculations in the book, hundreds of fictional characters. Sometimes you might not see yourself represented in certain content. We have enough, a 300+ page book giving examples of single, married, widow, widowered, examples of gifting to kids, gifting to relatives, inheriting money from different people. There's 38 chapters covering nearly everything we know about tax planning and through early retirement, but also even though the book says early retirement, it actually goes through, as we mentioned, the 5 phases. It's really 2 and 3 retirement, but really just emphasizing our focus, kind of our niche expertise in early retirement is beneficial. I also want to mention, I love that, Bill, you mentioned that we say in the book, an educated client gets the most value of working with a financial professional, right? So Bill and I didn't know what IRAs were until we were 30 and 50 years old. The less you know, the more scary it is to get advice, because you're not quite sure what to trust. But if you were to read this book and others within the field, assuming they're objective sources of information, if you have clarity and confidence over that information, then you go, like Bill, when you go work with a financial professional, you're going to be more selective with who you work with, but you're also going to feel even more comfortable if you know that they have the expertise that you already have, kind of trying to do it yourself.
Well, we're going to have an episode where I talk about my experience, because I just signed on the dotted line, and sin of all sins, I hired a professional to help me on a project-based retirement readiness thing. But as we've talked about today, this is not easy. I mean, it's not even simple. Retirement and drawdown is much more complex than accumulation portfolio and looking at accumulation tax savings and all that. Once you get that up and running, get the engine running, it runs on its own. But retirement is an active process. It has 5 phases. It has a lot of nuances. And yeah, you want to maximize or minimize your tax expense to maximize the money you can spend on yourself to live a complete, holistic, balanced life. The problem is you got these people that are at their highest net worth at death. We got to argue more about spending money in life, giving it away with QCDs or a donor advised fund, helping your kids in their 20s when they have the biggest need for capital, like house down payments these days with the astronomical cost of houses. When people that are able to do it, and not everybody can do it, but these are the things I'm thinking about. How do I pay it backward as well as pay it forward? And it's okay, it is okay to have the same net worth at death that you had when you retired. What's wrong with that? You still won the game. We don't have to identify with our money growing. We get too tied up in winning the game as opposed to the good enough balance that we all want to have. We're talking more about balance in accumulation, balance in retirement. We don't have to be the person that retires at 30. No, we don't have to be the person that retires at 40. We talk about 20 years to FI, 15 to 20 years to FI, which is why late starters can catch up using your tactics and techniques, using the accumulation techniques we've talked about. I mean, this is fun stuff, right, Jackie?
Yeah, it is. This has been wonderful, and we feel so honored that you guys don't mind stopping by. But we are so excited for you and this book, and I'm glad that you guys were the two to write it. We've got a brilliant CFP, a brilliant CPA. You cannot get better than this. That's part of the financial independence community that can take you from early retirement all the way through the end of life. And this has been extraordinary. So I'm going to let you guys have the last word. Congrats on the book. You've already sold 5,000 copies, which is a huge milestone. I know how hard it is to call a book finished. You had a major piece of legislation that happened before you were able to even finish it. So Sean, let's start with you. Just final thoughts.
Final thoughts is I think there's just great opportunity for good tax planning that doesn't have to be overcomplicated and doesn't have to be driven by fear. Look, I'm very interested in this stuff, but I think we wrote the book in a way that even those who don't have quite my level of interest can enjoy and can get some knowledge out of. And Bill and Jackie, thanks so much for having us on today. Really enjoyed the conversation.
Awesome. Awesome. Cody, final words from you.
Yeah, final words are that we love the optimized tactics, but the things we talk about, Roth conversions, tax gain harvesting, tax loss harvesting, QCDs, donor advised funds, none of these will make or break a retirement. None of these really change the lived experience of a retiree and their families. This isn't building a house. It's really just tightening the screws a little bit, right? So I just want to say that tax planning is worth optimizing, but not worth fearing. Because if you get to a place where taxes become a good problem to have, you've got a lot of good going for you to get to that place.
Yeah, I mean, when we're retired, do we really want to think about money or do we want to think about life? I mean, my goal is to get to that point, and that's one of the reasons I'm engaging with a planner like yourselves, is because I don't want to think about money anymore. I just want it to show up in the account. I just want to spend it on my family, my life, my friends, going to South Africa, going to Bali, and then the planner can take care of that for me. As long as I find a cost-effective, flat rate, fee-only, advice-only planner like yourselves, you can offload this stuff. Do I want to be DIYing this when I'm starting to lose my mental capacity? Do I want my wife to have to DIY this when I pass away if I'm managing it? No. Talk to an advisor. Talk to these guys. Look at the kind of advice they have to give. Thank you so much, guys, for joining us today on Catching Up to FI.
Appreciate you both.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our editor is Fritz Brazard. We love them and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofi.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to Fi. Cheers.